$100,000? For many people, this is a significant amount of money. It represents years of dedicated saving, disciplined investing, or perhaps a one-time windfall from an inheritance or a business sale. It is a sum large enough to feel substantial, a figure that carries the weight of opportunity. Reaching this milestone is a major accomplishment. It places you at a critical financial crossroads. The decisions you make with this capital can dramatically alter your financial future. It's not just money. It's a powerful tool that can be used to build substantial, long-term wealth if handled with care and precision. The path you choose for this $100,000 will set a precedent for your financial life for years, and even decades to come. This isn't a small decision, like choosing which stock to buy with a few $100s. This is a foundational choice. It could be the down payment on a property that generates rental income for the rest of your life. It could be the seed capital for a stock portfolio that compounds into a multi-million-dollar retirement fund. Conversely, a poorly researched or emotional decision could lead to significant losses, setting you back years in your financial journey. The stakes are undeniably high, making this a moment for careful thought. Many investors at this stage feel a mix of excitement and anxiety. The potential for growth is thrilling, but the fear of making a mistake can be paralyzing. It's easy to get caught up in headlines about the next hot stock or a booming real estate market. Friends and family might offer well-intentioned but conflicting advice. One person might swear by the tangible security of property, while another might champion the liquidity and historical returns of the stock market. Navigating this noise requires a clear, objective framework. It requires cutting through the opinions and focusing entirely on the numbers, the data, and the facts. This analysis is designed to provide that clarity. We are going to strip away the emotion and the hype. Instead, we will conduct a deep data-driven breakdown of the most common investment paths for a $100,000 sum. We will explore the numbers behind real estate investing, from acquisition costs to cash flow. We will dissect the performance of the stock market, examining historical returns and volatility. The goal is to equip you with a comprehensive understanding of each option. This will empower you to make an informed decision that aligns perfectly with your personal financial goals, risk tolerance, and timeline. Making a major investment decision without a thorough analysis is like navigating a ship in a storm without a compass. You might get lucky and reach your destination, but it's far more likely you'll end up lost at sea. Precision is paramount when deploying a significant amount of capital. Every percentage point of return, every dollar saved in fees, and every risk mitigated can have a compounding effect over time. A small difference in your initial strategy can translate into tens or even hundreds of thousands of dollars in the long run. This is why a detailed, analytical approach is not just recommended, it is essential for success. The financial world is complex and filled with variables. Interest rates fluctuate, markets shift, and economic conditions change. A precise analysis accounts for these variables. It involves creating detailed financial models, stress testing your assumptions, and understanding the worst-case scenarios, not just the best-case ones. For example, when considering a rental property, a precise breakdown goes beyond the purchase price. It includes calculating closing costs, property taxes, insurance vacancy rates, maintenance expenses, and potential property management fees. Each of these details affects your true return on investment in a significant way. Similarly, investing in the stock market requires more than just picking a popular ETF. A precise approach involves understanding the expense ratios of the funds you choose, as these fees directly eat into your returns over time. It means analyzing historical data to understand the potential for drawdowns and the volatility you must be prepared to endure. It also involves considering your tax strategy. How will capital gains be treated? Are there tax-advantaged accounts you can use to maximize your growth? Overlooking these details is a common mistake that can cost investors dearly over the long term. Therefore, our entire focus will be on this level of precision. We will use real-world data, financial calculators, and detailed spreadsheets to model each scenario. This is not about finding a single best answer, because the right choice is different for everyone. Instead, this is about building a robust decision-making framework. By the end of this analysis, you will have the tools and the knowledge to run the numbers for yourself. You will be able to confidently evaluate your options, understand the trade-offs, and make a $100,000 decision based on logic and data, not on speculation or fear. Before analyzing investments, look inward. The best strategy is personal, tailored to your circumstances and goals. Define your investment criteria by asking critical questions. What are you trying to achieve? Rapid growth or steady income? These objectives lead to different paths. Your criteria are the blueprint. Without it, efforts are chaotic. Defined goals filter out misaligned options. Consider your willingness to commit time. Investing in a broad market index fund, on the other hand, is almost entirely passive. Your preference for active versus passive management is crucial. Quantify your desired outcome. Specific targets transform wishes into actionable plans, providing a performance benchmark. Every investment carries risk. There is no guaranteed high return without potential loss. Understanding your risk tolerance is critical to your financial framework. Risk tolerance is your capacity to withstand market fluctuations. An investment suitable for one person might cause another anxiety. Exceeding your comfort level can lead to panicked decisions, like selling at market bottoms, locking in losses. Quantifying risk tolerance requires considering your psychological makeup and financial situation. Psychologically, how would you react if a $100,000 investment dropped to $70,000 in a year? Would you see it as a buying opportunity, hold steady, or feel an urge to sell? This reveals your emotional capacity for risk. Financially, how would a significant loss impact your life? Is it your life savings or part of a larger portfolio? Risk tolerance profiles include conservative, moderate, and aggressive. A conservative investor prioritizes capital preservation. A moderate investor seeks balanced growth. An aggressive investor prioritizes maximum growth, enduring volatility for higher returns. Identifying your profile helps narrow investment options. Align your profile with specific strategies. A conservative investor might allocate $100,000 to high-quality bonds and dividend stocks. Your risk tolerance acts as a guardrail, ensuring a sustainable long-term strategy. The third pillar is your investment timeline. The length of time you plan to keep your money invested will heavily influence your strategy. Is this for a short-term goal, like a down payment in 3 to 5 years? Or is this for retirement that is still several decades away? A shorter timeline generally requires a more conservative approach. A longer timeline allows you to take on more risk in pursuit of higher returns. Closely related to your timeline is liquidity. How quickly you can convert an asset into cash without significant loss of value. Some assets are highly liquid, like stocks. Others are highly illiquid, like real estate. Before you invest, you must assess your potential need for cash in the near future. Balance your desire for returns with your need for financial flexibility. With $100,000, real estate leverage becomes your most powerful tool. Instead of buying a $100,000 property outright, use that money as a 20% down payment to control a $500,000 asset. This lets you benefit from appreciation and rental income on a much larger property. But your $100,000 must also cover closing costs, typically 2 to 5% of the purchase price, and reserves for repairs or vacancies. Don't spend every dollar, keep at least 6 months of expenses in reserve for emergencies. Smart allocation between down payment, closing costs, and reserves is essential for a secure start. Leverage amplifies both gains and risks. Use it wisely. Location is everything in real estate. With a $400,000, $500,000 budget, target markets where this buys strong rental income. Analyze data. Look for cities with population and job growth, diverse economies, and reasonable price-to-rent ratios. Drill down to neighborhoods with good schools, low crime, and amenities. These attract stable tenants. Avoid areas with high vacancies or declining values, even if prices seem low. A slightly higher price in a better neighborhood often means more profit and less hassle. Let's analyze a $400,000 home in a growing Midwest city. With 20% down, you borrow $320,000. At 7% interest, your mortgage is about $2,129 a month. Add taxes, insurance, vacancy, repairs, and management, totaling around $3,451 a month. If rent is $3,000 a month, you're losing $451 every month. This negative cash flow shows why detailed analysis is crucial. Don't rely on surface numbers, dig into every expense. If the math doesn't work, move on and find a better deal. Data-driven decisions prevent costly mistakes. Spreadsheets miss the hidden costs of landlording. Tenant turnover means lost rent and thousands in repairs and marketing. Major expenses like roofs or HVAC can wipe out profits if you don't save for them. Managing property takes time and emotional energy, even with a manager. Legal risks and liability are real. Insurance helps, but you must know the laws. Real estate is a business, not a passive investment. Be prepared for the full commitment before diving in. The stock market offers simplicity and instant diversification. With $100,000 you can buy shares of an ETF and own pieces of hundreds of companies. No mortgages, no repairs, no tenants, just open a brokerage account and invest. Broad market ETFs like those tracking the S&P 500 provide wide exposure and low risk. Investing is passive. Your main job is to stay disciplined and let your money grow. Costs are minimal. Expense ratios can be as low as 0.03%, or $30 a year on $100,000. For many, this hands-off approach is the biggest advantage over real estate. The stock market's allure for long-term investors lies in its wealth creation, driven by compounding. Compounding generates returns on returns, creating exponential growth over time. Dividends can be reinvested to buy more shares, accelerating growth. Historically, the S&P 500 has averaged approximately 10% annually. Let's consider a $100,000 investment. At 10% annually, it could reach $259,000 in 10 years, and $672,000 after 20 years, potentially $1.74 million after 30 years, demonstrating the power of long-term investing. With a long-time horizon, the stock market can generate life-changing wealth through compound growth. Stock market returns don't come in a straight line. The path is marked by volatility, the degree of price variation over time. This is the primary risk and biggest challenge of stock market investing. There will be periods, sometimes lasting years, where the market declines. The S&P 500 has experienced numerous bear markets defined as a 20% or more decline from its peak. During events like the 2008 financial crisis or the dot-com bust, the market fell significantly. This is the price of admission for achieving higher long-term returns. The greatest danger is the investor's reaction to market decline. Selling in a panic at the bottom is the single most destructive action. A successful investor must have the emotional fortitude to stay the course. Market downturns are inevitable, so are the subsequent recoveries. The best course of action during a crash has always been to do nothing or continue investing. The real risk is behavioral, abandoning your plan at the worst moment. For investors seeking real estate income without the responsibilities of being a landlord, real estate investment trusts, REITs, offer a compelling option. A REIT is a company that owns and operates income-producing real estate, such as apartments, offices, shopping malls, and warehouses. By purchasing REIT shares, you gain fractional ownership of a diversified property portfolio managed by professionals. REITs offer real estate exposure with stock market simplicity. Investing in REITs is as easy as buying a stock through a brokerage account. REITs are required to distribute at least 90% of their taxable income as dividends. This often results in high dividend yields, providing a steady stream of passive income linked to the real estate economy. The REIT's management team handles all operations. However, REIT share prices correlate with the stock market and can be volatile. REITs offer a convenient middle ground, capturing some benefits of direct property investment. While stocks and real estate offer high growth potential, they also carry significant risk. For investors prioritizing capital preservation, bonds are a key consideration. A bond is essentially a loan to a corporation or government, where the borrower pays periodic interest and returns the principal at maturity. Government bonds are considered very safe, while corporate bonds offer higher yields with slightly more risk. A bond ETF holding a diversified basket of bonds provides instant diversification and liquidity. Combining bonds with stocks in a blended portfolio can reduce volatility and smooth returns, especially during stock market downturns. A classic example is the 60-40 portfolio. This approach sacrifices some upside for less volatility, tailored to your risk tolerance. To make data-driven decisions, engage with numbers directly using analytical tools. The most fundamental tool is the spreadsheet. Microsoft Excel or Google Sheets are indispensable for any serious investor. They allow you to build custom financial models that reflect your specific situation. For real estate, create a detailed cash flow analyzer. For stock market analysis, spreadsheets are equally essential for tracking and projecting portfolio growth. Beyond spreadsheets, online calculators can streamline your analysis. For real estate, websites like Zillow and Redfin offer mortgage calculators. Similarly, for stock and ETF investing, numerous online tools can aid your decision-making process. Use these tools to test your assumptions, understand risk, and build a data-backed case for your chosen strategy. We've explored the financial landscape of a $100,000 investment decision. We built a personal framework defining goals, risk tolerance, and timeline. Real estate offers control but demands hands-on management. Finding cash-flowing properties requires diligence and understanding costs. The stock market offers simplicity and diversification through low-cost index funds. Compounding can grow a $100,000 sum significantly, but requires emotional resilience to weather market volatility. Hybrid strategies like REITs and bonds offer varied benefits. The optimal choice depends on your personal financial framework. This analysis empowers you with a process for objective, data-driven decision-making. Use the tools, challenge assumptions, and build a strategy aligned with your goals. Your $100,000 can secure a prosperous financial future with informed decisions.